Welcome to this session of Physical Academy tutorial on Taxation in Investment Appraisal. If you are coming across my lecture for the first time, please like the video, also share it with others. If you are a returning subscriber, thank you for being part of this channel. No, taxation is part of cash flows in investment decision or in discounted cash flows analysis. So I want you to take note of the following. In discounted cash flows analysis, items and effects or impact on cash flows. Number one item, we have cash inflows. Cash inflows. Cash inflows will result in tax payments. So when you have inflows, so tax will be paid on your cash inflows. Just like profit, if you have profit, it will result in tax payments. Then cash outflows. This will result in tax savings. Tax saving, just like when you have a loss, so it will result in tax savings. Then we have capital allowance. Capital allowance. Capital allowance will result in tax savings. Capital allowance will result in tax savings. Then number 4, we have balancing allowance. Balancing allowance. Balancing allowance will result in tax savings. Balancing allowance will result in tax savings. Balancing charge. Balancing charge will result in tax payments. Tax payments. It will result in tax payments. Number 5, we have the scrap value of the asset. Scrap value of the asset, no effect. It has no effect on taxation. Number 6, then we have working capital. Working capital. Working capital does not have effect on tax as well. No effect on taxation. Please bear the following in mind. Capital expenditure. Capital expenditure. No, capital expenditure is an outlay on non-current assets. Non-current assets. An outlay on non-current asset, that is capital expenditure. When a business buys a non-current asset, depreciation is charged. When a business buys a non-current asset, depreciation is charged in financial accounts. Depreciation is charged in the financial statements. Then when a business acquires non-current assets, no depreciation will be charged in the statement of profit or loss as an expense, and it will equally be used to reduce the value of non-current assets in the statement of financial position. However, depreciation is not an allowable expenses for tax purpose. Depreciation is not an allowable expenses, but capital allowance is granted in lieu of financial accounting depreciation for tax purpose. So we have capital allowance. So depreciation is not allowable, but capital allowance is granted in lieu of financial accounting depreciation. And capital allowance can also be called tax allowable depreciation. Tax allowable depreciation. So that is another word for capital allowance, tax allowable depreciation. So this capital allowance or tax allowable depreciation can be calculated in 2 ways. Calculation of capital allowance, calculation of capital allowance. Remember, I've examined the effect of capital allowance on cash flows, that capital allowance will result in tax savings. So how do we calculate the so-called capital allowance? So we have two ways of calculating this in taxation. Number one, we have the straight line method. Straight line method or fixed installment method. Under this method, the same amount is charged for tax allowable depreciation every year. The same amount, an equal amount, is charged every year. It means what you have as capital allowance for year one, the same amount is what you will have for year 2, year 3, and other years of the project or throughout the project life. So same amount is charged every year. So to calculate capital allowance using straight line method, so capital allowance equals to cost of the asset minus residual value. Another word for residual value is scrap value or survey value over estimated useful life of the asset. N equals to estimated useful life. Estimated useful life. Bearing in mind that I said capital allowance will result in tax savings. So, its capital allowance will be claimed as a relief. So, in tax. So, when you are computing tax, when you want to compute the amount of tax payable, capital allowance will be claimed as a relief from the profit. It will be deducted from profit before tax will be charged on the remaining amount. The remaining balance is called total profit or taxable profit. So it means after capital allowance have been claimed as a relief from the assessable profit, then the remaining balance will apply your tax rate to get the amount of tax payable. So I've told you that capital allowance will result in a tax saving. So in this lecture, we've examined 3 categories. I've made mention of capital allowance, I've made mention of balancing allowance, and at the same time, we have balancing charge. I've told you balancing allowance and capital allowance, they serve the same purpose. That is why I said the capital allowance and balancing allowance both will result in a tax savings. So, but you used to have a balancing allowance when there is a disposal of an asset for tax purpose, and the tax written down value of the asset disposed is greater than the sales proceed for tax purpose. That means where there is a disposal of an asset, you have the tax written down value where it is greater than the sales proceed of the asset, then you have what is called balancing allowance. If it were in financial accounting, the equivalent of balancing allowance is loss from disposal. That means the asset is sold as a loss. To get the loss from disposal, we have the net book value minus proceed. That means the net book value is equivalent to tax written down value for tax purpose. The net book value, which is carrying amount. So where that carrying amount, that is the net book value, where it is greater than the proceed, then you have loss from disposal in financial accounting. So the equivalent of the carrying amount for tax purpose is tax written down value. Carrying amount is to financial accounting. Carrying amount is called net book value. This is to financial accounting. But for tax purpose, taxation, it is tax written down value. So this is what is called tax written down value in taxation. So now in financial accounting, we used to have loss from disposal, where this carrying amount, where it is greater than the sales proceed, you have loss from disposal. But in taxation, it is called balancing allowance, not loss. It is called balancing allowance, where this tax written down value is greater than the sales proceed of the asset disposed for tax purpose. No, that is where you used to have the loss from disposal. Just as if you have the kind amount, if this is 1 million, if proceed is 800,000, the 1 million is greater than 800,000. That means you have loss from disposal of 200,000. You have loss from disposal of 200,000. That is, I've told you the nebu value. If it is 1 million and the proceed is 800,000, you have loss of 200,000. For tax purpose, if the tax written down value is 1 million and the sales proceed is 800,000, then you have balancing allowance of 200,000. That is the excess of the tax written down value of the asset disposed over the sales proceed. So that is balancing allowance. And I've told you that the balancing allowance and capital allowance both will result in tax savings. But balancing charge, on the other hand, that is where the sales proceed of the assets disposed is greater than the tax written down value. If it were in financial accounting, it would have been called profit from disposal. So, if it will have been profit from disposal, that is the current amount, if it is 1 million and the sales proceed is 1.3 million, then you have profit from disposal of 300,000. That is in financial accounting. But in tax purpose, if current amount is 1 million and the sales proceed is 1.3 million, then you have balancing charge of 300,000. Therefore, balancing charge is the excess of the sales proceed of the asset disposed over the tax written down value of the asset. So I've told you have the tax written down value is lower this time around than the sales proceed. But in financial accounting, it is called profit from disposal. But in taxation, it is called balancing charge. And I've told you that the balancing charge will result in tax payments. It will result in tax payments. Please bear that in mind. So I want you to examine the calculation of capital allowance using straight line method. Example 1. An asset costing 120,000 naira and has an expected economic life of 5 years with no residual value. If depreciation is allowed for tax purpose over 5 years using the straight line method, tax rate is 30% and the scrap value of the asset at the end of the 5 years is required. Calculate the tax savings on the annual capital allowance. So you have to use straight line method. So we said, now, solution. And I've told you that annual capital allowance using straight line method. And since you have to use straight line method, straight line method is required. And I've told you it is equal to cost of the asset minus residual value. And I've told you that the residual value can also be called the scrap value or the salvage value. And how much is the cost of the asset? An asset costing 120,000 naira. The cost of the asset is 120,000 naira minus residual value. How much is the residual value of the asset? With no residual value. That means the residual value of the asset is 0. And what is the life of the asset? Has an expected economic life of 5 years. So we have 5 years as the economic life of the asset. 120,000 divided by 5, that gives us 240,000. So the annual capital allowance capital allowance, that will be 24,000 naira. That is 24,000 naira will be charged every year as capital allowance. And you have to calculate the tax savings on the annual capital allowance. So tax savings now, tax savings. The tax rate is 30%. So you have 30% of 24,000. And that will give you the tax savings on annual capital allowance. 30% of that gives us 7,200 naira per annum. That is the amount of tax that will be saved. So if tax is payable in the same year, if the tax is payable the same year as profits arose, same year, that means this tax savings will be used in year 1 to 5. The 7,200 will be used in year 1 to 5. But if tax is payable a year in arrears, that is, there is 1 year delay in payment of tax. So that means the tax savings will be used for year 2 to 6. If it is a year in arrears, you have it for year 2 to 6, 7,200 naira. The second method is reducing balance method. Reducing balance method. Under this method, the capital allowance is calculated by applying the capital allowance rate times the tax written down value of the asset. You apply the capital allowance rate on the tax written down value of the asset. So that means the capital allowance will be in diminishing pattern. It will be reducing. That is why it is called reducing balance method. Example 2. An asset costs 120,000 naira. Tax allowable depreciation is 25% on reducing balance method. Tax on profit is payable at the rate of 30%. Required to calculate the annual tax savings on capital allowance. Now, solution. We have tax savings on capital allowance. So we have here, year 1, we have the cost of the asset to be 120,000 naira. The capital allowance is 25% of the cost. 25% of 120,000. 25% of 120,000, that gives us 30,000. Tax savings on capital allowance at the tax rate is 30%. You calculate 30% of this 30,000. That is 30% of 30,000, which is your capital allowance. So the 30% of that, it gives us 9,000. That is tax saving in year 1. So year 2, you now have tax written down value of the asset. If you subtract 30,000 from 120,000, you'll be left with 90,000. Then capital allowance for year 2, which is 25% of 90,000. What is 25% of 90,000? That gives us 22,500. So 30% of 22,500. 22,500, 30%. 30% of 22,500, that gives us 6,750. 6,750. That is the tax savings at the end of year 2. Then year 3, you have the tax written down value of the asset, which is 90,000 minus 22,500. That gives us 67,500. Year 3, you have capital allowance, which is 25% of 67,500. 500. 25% of 67,500. That gives us 16,875. Then if you calculate 30% of that, that gives us 5,063 approximately. 5,063. That's what we have as the tax savings at the end of the year 3. If you subtract this from 67,500, then you'll be left with 50,625. 50,625. Then that is year 4, tax written down value. So what will be the capital allowance at the end of the year 4? Capital allowance will be 25% of 50,625. What is 25% of that? There you have 12,656. 12,656. So calculate 30% of that. Then you have 3,797. 3,797 approximately. Now, remember, since the capital allowance rate is given to be 25%, that means this project is expected to last for 4 years. So you have the tax written down value. If you subtract 12,656 from 50,625, so you'll be left with 37,969. So the sales proceeds of the assets, that is the scrap value, is nil. So that means, had it been the scrap value, you would have subtracted to get either the balancing allowance or balancing charge. I told you you have balancing allowance where the tax written down value is greater than the sales proceed, and where the sales proceed is greater than the tax written down value, you get the balancing charge. But in this case, so you'll be having the balancing allowance. Balancing allowance. That is, the tax written down value is greater than sales proceeds. So you have balancing allowance of 37,969. If you apply your tax rate on this, the tax rate of 30%, you have the tax savings of 11,391. 11,391. So that is the tax savings at the end of the project life. You may sum up these two. So as the tax savings, you know it is 30% of this that gives us this. 30% of this gives us this. So that is the calculation of capital allowance. So I want to take a question, a detailed question as work example. Keep watching. Example. This question is obtained from Workout Financial Management by Ade Omoleyiwa. Femi Limited manufactures motor vehicle components. It is considering introducing a new product. Tayo Okpe, the production director, has already prepared the following projections for this proposal. 6. 8,750,000, 12,250,000, 13.3 million, and 14,350,000 for year 1, 2, 3, and 4 respectively. Direct materials, 1,340,000, 1,075,000, 2,250,000, and 2,625,000. Direct labor, 2,675,000, 3,750,000, 4.5 million, 5,250,000. Direct overheads, 185,000, 250,000, 250,000, and 250,000 for year 1, 2, 3, and 4 respectively. Depreciation, 2.5 million, 2.5 million, 2.5 million, 2.5 million for each of the years 1, 2, 3, and 4 respectively. Interest is 1,012,000 for each of the years 1, 2, 3, and 4 respectively. Profit before tax, 1,038,000 for year 1, 2,863,000 for year 2, 2,788,000 for year 3, 2,713,000 for year 4. Income tax at 30% tax rate, 311,000 for year 1, 859,000 for year 2, 836,000 for year 3, 814,000 for year 4. We have profit after tax of 727,000 for year 1, 2,004,000 for year 2, 1,952,000 for year 3, 1,899,000 for year 4. Tayo has recommended to the board that the project is not worthwhile because the cumulative after-tax profit over the 4 years is less than the capital of the project. As an assistant accountant at the company, you have been asked by Kenny Lola, the chief accountant, to carry out a full financial appraisal. He does not agree with the Tayo's analysis and provide you with the following information. The initial capital investment and working capital will be incurred at the beginning of the first year. All other receipts and payments will occur at the end of each year. The second bullet or asterisk. The equipment will cost 10 million naira. The third asterisk. Additional working capital of 1 million naira. The next one. This additional working capital will be recovered in full as cash at the end of the 4 years period. The next one. The equipment will qualify for a 25% per annum reducing balance written down allowance. Then we have any outstanding capital allowance at the end of the project can be claimed as balancing allowance. At the end of the 4-year period, the equipment will be scrapped with no expected residual value. Then we have the additional working capital requires does not qualify for capital allowances, nor is it an allowable expenses in calculating taxable profit. Femi Limited pays income tax at 30% of chargeable profits. There is a 1-year delay in paying tax. Then we have the company's cost of capital is 17% required. Write a report to Kenny Lola. Your report should A. Evaluate the project using net present value techniques. B. Recommend whether the project is worthwhile. Solution. The name of the entity is Femi Limited. So I want to have this as an appendix to the report. So we have Femi Lola or Femi Limited. For the purpose of the net present value, we want to calculate the cash flows associated with the project. I will calculate the net present value in 2 ways. Whichever method you prefer under the exam condition you may go with it. So we have 4 years in question. So calculation of, let's say, cash flows. Calculation of net cash flows. Let me have this as method 1. You have 4 years involved. Year 1, year 2, year 3, year 4, so yes. The first item is sales. Sales or revenue, 8,750,000, 12,000,000, 250,000, 13.3 million, and 14,350,000. These are the sales for each of the years 1, 2, 3, and 4. Then we have direct materials. Direct materials. These are costs. Materials and outflows 1,340,000. 1,075,000. 2,250,000. And 2,625,000. After materials, we have direct labor. Direct labor. Direct labor 2,675,000. Then 3,750,000. 4.5 million. Then 5,250,000. Then direct overheads. Direct overheads. We have 185, 250 for each of the other years. After direct overheads, the next item is depreciation. Depreciation is not a cash flow. It's not a cash flow. If you have watched my earlier video on relevant costing for investment appraisal purpose or for discounted cash flows analysis, you will agree with me that depreciation is not a relevant cost. It's not relevant because it is not a cash flow. The interest. Remember, I've told you discounting means the calculation of the present value. And we normally calculate present value in order to account for the time value of money. If present value is calculated to account for the time value of money, then why do we charge interest as well? You are charging interest when you lend someone money. You normally charge interest on the money lent in order to account for the time value of money. You can see that the discounting, that is the present value calculation, and interest normally charged on loans too, they serve the same purpose. Both are meant to account for the time value of money. So if interest and the present value are meant to account for the time value of money, therefore, interest on money borrowed to finance the project, if it is brought into your cash flows, it will amount to double counting. Interest on money borrowed to finance the project, if it's form part of your cash flows for present value calculation, for NPV calculation, or for IRR calculation, it will amount to double counting. Therefore, anytime you have interest on money borrowed to finance the project, you should ignore it. It is not to be considered. So please bear that in mind. So we won't consider the interest. Now, after all this, you have the profit before tax. No, that is after all those deductions. The income tax. The income tax you are given in the question is just a tax provision. And provision for tax is not relevant for discounted cash flows analysis. So, we can net this. Let's net it. 8,750. 8,750 minus 1,340 minus 2,675 minus 185. You have 4,550. 4,550. This is cash profit. That is, this is profits, sales minus costs. So those, we did not consider those items that does not involve flows of cash. We did not consider items like depreciation. So it means the only cash flows that were used are those ones that involve cash. Those ones that involve the inflows or outflows of cash. So for year 2, 12,250 minus 1,875 minus 3,750 minus 250. So you have 6,375. For year 3, you have 13,300 minus 2,250 minus 4,500 minus 250. So this gives us 6,300. For year 4, 14,350 minus 2,625 minus 5,250 minus 250. So we have 6,225. 6,225. Now, you can include tax. The next item to consider as part of our cash flows is tax. I've told you the tax provisions you have in account cannot be used because it's just an estimate. It's a provision. It does not involve the flows of cash. So the actual amount to be paid as tax is what will be used. The one calculated on cash profit, that is the one that will be considered, not the one calculated using accrual basis. So because taxation takes cash concept or cash basis into consideration, so the tax calculated on accrual, because this one was calculated on profit before tax here. So, and that will not be used. So now we want to calculate tax payments. And what is our tax rate? 30%. So you calculate your tax on this. What is 30% of 4,550? We have 1,365. 1,365. That is the amount that will be paid as tax on that. Now, 6,375. What is 30% of that? We have 1,913. 1,913. 6,300. 30% of that. 1,890. I put the tax in bracket, in braces, because it's a payment which will result in an outflow of cash. That is why I put them in braces. So 6,225 times 30%, that gives us 1,868. 1,868. So that is the amount that will be paid as tax. The next thing is tax savings. As tax savings on capital allowance. The capital allowance that will be calculated will lead to tax savings, since capital allowance is usually deducted in form of a relief. That means if it is to be deducted as a relief, it will reduce the amount to be paid as tax. That is why we will have tax savings on capital allowance. On capital allowance. So same rate is used. So it means before this can be calculated, you must have known your capital allowance. Which method is to be used? What method of capital allowance calculation is required? Is it a straight line method or reducing balance method? If you have gone through my earlier explanation, remember I've told you we have two methods. We have the straight line method and we equally have the reducing balance method. We're told the initial capital investment and working capital will be incurred at the beginning of the first year. So if it will be incurred at the beginning of the first year, if you have gone through my earlier video on relevant costing for discounted cash flows analysis, I've told you the cash flow that arises at the beginning of the year. I said a cash flow that arises at the beginning of the year will be used in the immediate preceding year. So since it occurs at the beginning of the first year, that means it will be used in year zero. Initial capital investment will be used in the year zero, and working capital also will be used in year zero. That is the implication of that. So the equipment will cost 10 million. So you treat your 10 million as an outflow in year zero. Additional working capital of 1 million. The working capital of 1 million will also be used as an outflow in year zero. So that is the implication of what we have in the first asterisk. So here. So you were told this additional working capital will be recovered in full as cash at the end of the 4-year period. So if it will be recovered as cash at the end of the 4-year period, that means in the year 4, you will now treat it as an inflow again. Remember, the working capital have been treated as an outflow in year 0. Then in year 4, which is the end of the project life, you will equally treat it as an inflow. So that is the true treatment of working capital. That is what we have here. So you were told the equipment will qualify for 25% per annum reducing balance written down allowance. So that means the reducing balance method is to be used in calculating the capital allowance. So you have to use the reducing balance method in calculating capital allowance. So the rate to use is 25% per annum. Any outstanding capital allowance at the end of the project can be claimed as balancing allowance. So any balance you have at the end of the project, you treat it as a balancing allowance. Then at the end of the 4-year period, the equipment will be scrapped. So with no expected residual value. So it means the residual value of the equipment at the end of the project will be 0 since it has no expected residual value. So now let's quickly calculate the capital allowance on the project. So now let's have calculation. Let me say calculation of tax savings on capital allowance. Tax savings on capital allowance at the tax rate is 30%. So it means you calculate 30% of the capital allowance, and that will be claimed as tax savings. So this is 30%. So year 1, we have cost. The cost of the asset is 10 million naira. 10 million. And you are given the capital allowance rate to be 25% per annum using the reducing balance. So we have capital allowance, which is 25% of 10 million. That will be 2.5 million. If you subtract 2.5 million from the 10 million, then you have the tax written down value. Tax written down value of 7.5 million. The 7.5 million is obtained when you subtracted 2.5 million from 10 million. That is 10 million minus 2.5 million. The tax savings on capital allowance, the tax rate is 30%. Calculate 30% of the capital allowance, 30% of 2.5 million, that gives us 750,000. So our tax savings on capital allowance is 750,000. The 750,000 is obtained by calculating 30% of 2.5 million. 30% of this gives us the 750,000 we have here. So, in the second year, the capital allowance will be 25% of 7.5 million. 25% of 7.5 million. That gives us 1875. 1875. That is the capital allowance for the year. If you calculate tax on that, that is 30% of 1875. 30% of that gives us 563, approximately equal to 563. That is the tax savings on capital allowance for the second assessment year. So the third year, you have the tax written down value. The tax written down value, you have 7.5 million minus 1875. That gives us 5625. That is the tax written down value. On this, also, you can calculate the capital allowance for the third year, which is 25% of 5625. 25% of that. That gives us 1,406. 1,406. If you want to calculate the tax savings, you have 30% of 1,406. So what is 30% of 1,406? That gives us 422, approximately 422. That is the tax savings on capital allowance for the third assessment year, 422. So you have year 4, tax written down value. The tax written down value, we have 5625 minus 1,406. Then we have 4,219 as the tax written down value. So capital allowance for this year, for year 4, that will be 25% of 4,219. The 25% of that gives us 1,054. 1,054. That is the capital allowance for 55, approximately. 1,055, approximately. Tax savings on that, 30% of that, 317. That is 30% of 1,055. That gives us 317. That is the tax savings on capital allowance. So, the project lasts for 4 years. 4,219 minus 1,055. Then you have 3,164. Now, this ought to be the tax written down value. But what is the proceed? You were told these assets have a nil residual value, no expected residual value. Since it have no expected residual value, you were told the equipment will be scrapped with no expected residual value. So if it doesn't have expected residual value, that means the residual value at the end of the project life, which is year 4, is nil. So if it is nil, then this will be balancing allowance. So that is the balancing allowance. So with no expected residual value, the additional working capital required does not qualify for capital allowance, nor is it an allowable expenses in calculating taxable profit. Femi pays income tax at 30%. There is 1 year delay in paying tax. The company cost of capital is 17%. So, if this is the balancing allowance, so what will be the tax on this? 30% of 3164. 30% of that. So we have 949. 949. Since this is the end of the project life, if you sum up this, 949 plus 317, then you have 1266. That means the capital allowance, the tax savings will be 1266. This 1266 is the sum of these two. When you add 317 and 949 to give you 1266. So that is the tax saving in year 4. Now that we've calculated the capital allowance and the tax savings, in year 1, we have tax savings of 750. That is what we have in year 1, 750. Savings is an inflows. In year 2, you have 563. 563. Then in year 3, you have 422 as the tax savings. In year 4, we have 1266 as calculated. So you can sum up this. Your tax is an outflows. Your tax savings is an inflows. 1365. If you subtract 750 from that, if you net it, you have 615 as the amount of tax payable here. That is tax payment. This is greater than this. Then 1913, 1913. If you take 563 from that, then you have 1350. That is the tax payment. The difference between this. 1890 minus 422, you have 1468. 1468. That is the tax payment. Then 1868 minus 1266. So you have 602 as the amount payable as tax. So I've been told Firming Limited pays income tax at 30% of chargeable profits. There is a 1-year delay in paying tax. If the payment of tax is delayed by 1 year, that means payable in year. This tax you have in year 1, that will be paid in year 2 since 1 year delay in payment of tax. The one for year 2 will be paid in year 3, and the one for year 3 will be paid in year 4, and the tax in year 4 will be paid in year 5, since there is 1 year delay in payment of tax. That is, the tax is payable a year in arrear. So that is why you have it in this order: year 2, 3, 4, 5. No tax will be paid in year 1. We want to calculate the net present value of the project. Calculation of NPV. So you have year 0, year 1, 2, 3, 4, 5. And the amount is in 1,000 naira. So we have net, you have cash profit. So let me say, okay, the equipment will cost this. So we have outlay. Equipment costs 10 million. Outflows in year 0. Since it doesn't have any scrap value, that means had it been the scrap value, the scrap value will have been treated as an inflow at the end of the project life. Then we also have working capital. Working capital. Additional working capital of 1 million naira. So we say it will be treated as an outflow in year 0. Then it will be recovered at the end of the project life. Then you now have it as an inflow. The end of the project life is year 4. So you now treat it as an inflow at the end of year 4. So we have, aside this, we have cash profit. Cash profit. Cash profit. In year 1, you have 4,550. Year 2, 4,550 in year 1. Year 2, 6,375. Year 3, 6,300. Year 4, 6,225. Then tax payments. Tax payments. No tax is payable in arrear. We said the first tax, we said that will be paid in year 2. So, and that is 615. It will be paid in year 2. So we have it in year 2, 615. Then we have 1,350 that will be paid in year 3. Then 1,468 it will be paid in year 4. Then 602 that will be paid in year 5. Now, there are no other cash flows. Since there is none other, so you have your net cash flows. Minus 10,000 minus 1,000, that is minus 11,000. This is 4,550 as an inflows. Then 6,375 minus 615. That gives us 5,760. 5,760. 6,300 minus 1,350. That gives us 4,950. Then 1,000 plus 6,225 minus 1,468. We have 5,757. So 1,000 plus 6,225 minus 1,462. Then this is minus 602. So this is our net cash flows. We now discount our net cash flows using the cost of capital provided. You were told the company cost of capital is 17%. So that means the cost of capital that will be used in discounting our cash flows will be 17%. So you now calculate the cost of capital at 17%. Discount factor, the formula is 1 plus r raised to power minus n. So, r is 17%. 1 plus 0.17, that will be 1.17 raised to power minus n. So, for year 0, discount factor at 17%. Year 0 will be 1. So, year 1, if you take your n to be minus 1, 1.17 raised to power minus 1. So, some calculator, the exponential function is like this. Some is like this. Or x raised to power y. So, it depends on the calculator you are using. So, that is exponential function. So, 1.17. So, for year 1, we have 0.855. Year 2, 0.731. Year 3, 0.624. Year 4, 0.534. Year 5, that is 0.456. What is the PV of that? Present value. 11,000 times minus 11,000 times 1, that would be minus 11,000. 4,550 times 0.855. Then you have 3,890. 5,760 times 0.731. That is 4,211. 4,950 times 0.624. That is 3,089. 3,089. Then 5,757 times 0.534. That gives us 3,074. 3,074. Then minus 602 times 0.456. That gives us 275, approximately negative. So what is the NPV of the project? 3,890 plus 4,211 plus 3,089 plus 3,074 minus 275. Then if you subtract 11,000, so we have 2,989. 2,989. Therefore, the net present value of the project is 2,989,000. Positive. Method 2. Calculation of tax payment. Of tax payments. So, the calculation of cash profit will still be the same. And the calculation of our capital allowance will be the same. So you can have capital allowance. You know, if this were taxation, this would have been the assessable profit. From the assessable profit, we now deduct the capital allowance. After deducting capital allowance from the assessable profit, then you will arrive at the total profit. So we want to deduct the capital allowance now. Year 1, our calculated capital allowance is 2,500 from our earlier working. 25. Year 2, we have 1,875 as our capital allowance. 1,875. Year 3, we have 1,406 as our capital allowance. 1,406. And year 4, we got 1,266. 1,266, which comprises the capital allowance for the year and balance. Which comprises. This addition 1,055 plus 3,164. That will be 4,219. The capital allowance for the year 4 will be the sum of the capital allowance for the year and balancing allowance. Addition of these two. So we give you the capital allowance for year 4. And the addition of these two will be 4,219. So that will be the capital allowance for the year. So that means for year 4, we have 4,219. 219. That is the capital allowance for the year. Now, 25 year 1, 1875 year 2, 1406 year 3, 4219 year 4. If you deduct capital allowance from this is accessible profit. Let me just say accessible profit. Accessible profit. Accessible profit minus capital allowance will give you total profit. Total profit, which is the same as the taxable profit. 4,550 minus 2,500. We have 2,050. Tax payable at the tax rate is given to be 30%. What is 30% of 2,050? That gives us 615. That is the amount of tax that is payable in the year. Then year 2, 6375. 6375. 6375 minus 1875. That gives us 4,500. Then tax at 30%. 30% of 4,500 will be 1,350. Then year 3, 6,300 minus 1,406. That gives us 4,894. 4,894. What is 30% of that? That gives us 1,468. 1,468. That is the amount payable as tax in year 3. Year 4, 6,225 minus 4,219. There you have 2,006. So tax at 30% tax rate. There you have 602 approximately. Payable in year. When would this tax be paid? Remember, you have been told that there is 1 year delay in payment of tax. There is a 1 year delay in paying tax, and you were told in the note there is a 1 year delay in paying tax. If there is 1 year delay, that means it is payable a year in arrears. If it is 1 year delayed, the tax for year 1 will be paid in year 2. The one for year 2 will be paid in year 3. The one for year 3 will be paid in year 4. The one for year 4 will be paid in year 5. So that is the tax payment. Now we can now proceed to the calculation of capital allowance for the year. Calculation of net present value rather. Calculation of NPV. So we have year, let's say year 5, year 4, year 3, year 2, year 1, and year 0. Amount is in thousand. So you already have the cash profit, which was our accessible profit. Cash profit of 4,550. Cash profit. That is year 1, 4,550. Year 2, 6,375. Year 3, 6,300. And in year 4, we have 6,225. 6,225. That is what you have in year 4. 6,225. 6,225. Tax payments. Remember, the first tax will be paid in year 2, 615. That will be paid in year 2, 615 in year 2. Then 1,350 will be paid in year 3, 1,350. Then 1,468 will be paid in year 4. And 602 will be paid in year 5. So after this, you have outlay of 10 million in year 0. Then we also have working capital of 1 million. We say it will be treated as an outflow in year 0. At the end of the project life, which is year 4, it will be treated as an inflows. So after all this, you have your net cash flows. What are the net cash flows of these projects? So net, this is working capital. Net cash flows. This is 11,000. This is 4,550. 6,375 minus 615. We have 5,760. Then 6,300 minus 1,350. And that is total 4,950. Then for the year 4, 6,225 minus 1,468 plus 1,000. And that is total 5,757. For the 5th year, you have minus 602. And these cash flows will be discounted. The cost of capital is given to be 17%. For year 1 will be 1.17. For year 0 to be 1. Year 1 we have 0.855. Year 2 we have 0.731. Year 3 we have 0.624. And in year 4 we have 0.534. And for the year 5 we have 0.456. 0.456. And what is the present value of that? The present value will be cash flows, net cash flows times the discount factor. So we have minus 11,000 for year 0, 4,550 times 0.855, and that gives us 3,890. Then 5,760 times 0.731, and that gives us 4,211, 4,211. For year 3, 4,950 times 0.624. That gives us 3,089. 3,089. Then for the year 4, 5,757 times 0.534, and that gives us 3,074. 3,074. Then 602 times 0.456. That gives us the minus 275. Now, what is the total of that? 3890 plus 4211 plus 3089 plus 3074 minus 275 minus 11,000. So we have the net present value to be 2,989. So therefore our NPV, the amount is in thousand, is 2,989,000. So since the NPV is positive, that means the investment is a viable one. The project is a viable one. So it is financially worthwhile. Therefore, the entity should accept the project. That is the investment the project worth investing in. So this marks the end of the solution to this question. In my next video, I will examine the inflation in investment appraisal or inflation in capital investment decision. Please drop the love emoji, like the video, and also share it with others. Thanks for watching ICAN. Bye for now.